Hello friends. Last week in my video, I advocated that the market was precariously poised. Precariously would mean very dangerously poised, possibly at a slippery slope, and that we should be waiting for bigger moves to unfold in the week ahead. And look what happened. The moves were fairly large, and especially what happened on Friday to the Nifty should have told you that the time for larger big beta, which means big statistical beta and pure price volatility are here. Now in this video, I want to discuss how to take this going forward. Now coming up on your screen is the weekly chart of the market roundup window, and what you can see is that as again like the previous couple of weeks, it was the broad-based Nifty 50 which led the decline and the Bank Nifty followed suit. The US dollar index, the Dixie, shot up again, and that had a negative impact on emerging markets including India. Commodity prices fell. Crude oil and natural gas fell because I told you these are more of seasonal rallies rather than a structural bull market. The United States dollar versus the Indian rupee saw huge gains, which means the Indian rupee slipped against the dollar after a very brief relief rally in the week prior. Indian 10-year benchmark bond yields fell marginally, rose marginally, I beg your pardon, which means bond prices went down a little, pressurizing the banking stocks. NSE market capitalization fell a whopping 4.56%. Now this, frankly, is a huge cause of concern for me, because such a loss in market capitalization tells you that the sell-off was very, very widespread in the market. MWPL, or market-wide position limits, fell sharply, and that is routine on expiry. Where the US headline indices are concerned, apart from the Dow Jones Industrial Average, which just about managed to stay in the positive, Nasdaq and S&P 500 fell. Now the Nasdaq is a tech-heavy index, so possibly IT stocks in India in the coming week may remain under pressure. Friends, I now come to our in-house indicators, and this video here tells you why I consider MWPL to be quite simply one of the finest indicators you should follow. So now on your screen right now is the MWPL indicator. You can see that at 25.50 post expiry, it is marginally higher than the prior month's post expiry week. This is in spite of the fact that there have been changes in the F&O list. Therefore, it tells you that there is still hope floating in the retail camp. They are waiting and hoping for prices to go up. But then high MWPL is a double-edged sword. Not only does it indicate hope, but it also tells you that people are buying nervously, and should there be any negative news trigger emerging, it could lead to a crowded exit. And I'll come to that in the last segment of this video in my own weekly trading strategy. Now friends, take a look at the turnover, and this is a weekly chart of all three expiries. So it is March, April and May futures turnover. Now this is stock and indices. Obviously stock futures turnover is shot up primarily due to rollover process in expiry. People are squaring up their February futures and rolling over to the March futures, and that's what results in a spike in turnover. That also is a sign of hope. People are hoping and rolling forward their positions. Now for the NSE advanced decline ratio, it's slipped very, very sharply. At 0.39 compared to prior week's 1.38, it tells me that there were 39 gaining stocks for every 100 losing stocks. Very poor ratio. We need to stay above 1.0 if at all bulls are to have a fighting chance to lift up the markets again. Now friends, I come to the Nifty and Bank Nifty prompt futures basis. Basis is nothing but the premium or discount prevalent on the futures compared to spot. Just like options premium, basis also contracts as expiry approaches. So now this is a new month, which is why you're seeing the regular 4-weekly spike in basis. Can this basis last? I don't think so. Statistical weight of evidence tells me that in the very next week, you'll see a fall in this basis. At this point in time, there is hope in the market. Now, friends, I come to our in-house indicator, the impetus, and that tells me that the bank Nifty has fallen last week with almost flat impetus. There was no excessive selling pressure in the bank Nifty, which of course fell much less than the Nifty 50. But take a look at the blue line, which is the Nifty 50. The impetus reading is higher sharply. That means the Nifty has fallen last week with forceful selling. Now that is not exactly good news. Now, friends, I come to our in-house indicator, the lift, weight, thrust, drag indicator, or the LWTD. It's done its job excellently well for 3 years now, almost 4 years now. And what you're seeing is that the LWTD has fallen sharply from minus 0.14 in the prior week. It has fallen to minus 4.7 last week. That tells me that coming week will see very feeble and very limited fresh buying support. Does it mean there'll be no short covering? Hey, short covering can always come, but short covering will either cushion the market declines or might trigger a temporary bear market rally, which can be very vicious, but again, temporary in nature. Now, where do you get all these in-house indicator details? They are there on my social media accounts, posted every single day, late at night or very early next morning before the market opens. Do connect with me. My contact coordinates are at the fag end of this video, in the pinned comment below, and in the description below this video. Friends, in-house indicators done. I now come to the bond market, which is very close to my heart. Now, the bond market is basically sending out signals to you that the last word on coupon rates or interest rates have not been spoken yet. According to me, and you can please feel free to agree to disagree with me, and the comment segment is open for you. According to me, the interest rate, coupon rate hike is not ended and rates haven't peaked out yet. Do remember that if at all there is any sign that the government will exceed the target of borrowing from the bond market, which the Honorable Finance Minister has specified in the budget, the bond yields will suddenly spike. That tells me that cost of funds is likely to stay ahead. Look at the weekly chart of the Indian 10-year benchmark bond yields. Now, slowly but surely, it's inching upwards after peaking out 5 weeks ago. You can see that bullish hammer made 5 weeks ago, and after that every week the yields are rising mildly. Now, if at all you cross the 6.9 6.95 kind of threshold, chances are that the market is basically making up its mind about something. So what should you do? I think you should keep the powder dry. Don't write out a check in gilt funds, and let's definitely not rush into the sovereign bond yet. Because do remember, since October 2021, when I told you that rates have bottomed out and cost of funds will rise, we have laddered all the way up to 7.5%. So you're sitting in a prime plum position. Let's not write out checks at 6.7 and 6.75 and then drag down the average yields that we have laddered so far. I assure you, I will alert you on my Telegram channel first, foremost, and always. Friends, the bond market's done. I now come to the bank Nifty, which outperformed the Nifty 50 by falling less. It fell 1.30% last week, and it fell on 4 out of 5 trading sessions, as the daily chart on your screen tells you. It stayed below the neckline of a irregular and unconventional head and shoulder pattern. That's a sign of weakness. The price also stayed below the monthly average, so the short-term outlook is negative for now. Now, a crossover above the 50,000 mark is what is required as a bare minimum to change the outlook on the bank Nifty. Do remember, banking and financial sector stocks command a weightage of 34.35% in the Nifty 50. So only a rally in the bank Nifty can revive the markets. Without the banking space, sorry, market rally not happening. Now let's go to the weekly chart, which shows a relatively small bodied bearish candles, but the price remains below the 25-week moving average, which is a proxy for a 6-month long holding on cost. and it stayed below this on a closing basis for the 10th week in a row. That tells you the kind of pressure that's prevalent in the market. Now, like I said, only a crossover above the 50,000 mark and therefore crossing the 25-week exponential moving average also will change sentiments. Friends, in the week before last, this index was number 4 on the statistical beta rankings that I maintain in-house of most volatile counters. It fell 6 notches to number 10. Hold on, don't pop out the champagne yet. It's not that the banking index volatility has gone down. It's just that stock price volatility has gone up relatively much more faster. You know what hell we saw in the markets last week? Hell for bulls, not for bears. So, it's just that volatility in stock futures has risen faster than the bank nifty, so the bank nifty seems to have calmed down. It's not so. Let's not get delusional about it. Let's stay real. Last week, I advocated an estimated a range between 50,725 on the upside and 47,225 on the downside, which held perfectly well. In the coming week, I estimate a range between 49,875 on the upside and 46,800 on the downside. Now, friends, in addition to this range, also monitor our daily, weekly, monthly pivots, which I upload on our free Telegram and WhatsApp channels. Contact coordinates available in the link below. And also, please watch this video about how you can use our pivot points to laser precise your entry and exit in options and futures trading. Friends, the Bank Nifty done, I now come to the Nifty 50, which lost 2.94% last week and fell on all 5 days last week. The price is deeply below its monthly average and it's testing the low of 5th of June 2004. The short-term outlook is therefore negative for now. Now let's take a look at the weekly chart. It shows a bearish power candle, which is a large bodied candle. And the price is staying below its 25-week exponential moving average, which is a 6-month long holding on cost of an average bull. That tells you that the medium-term outlook is negative for now. The price has closed for 11 weeks in a row below this moving average. That means there is a overhead supply. That means selling coming from traders who are trapped at higher levels and they are exiting the market whenever their break even comes in. So there will be overhead supply. Only once this overhead supply is absorbed can you hope for a new rally. That means there should be a close above 23,600 or even 23,800 before you can write out a check. Seems a little odd that you would want to wait for a 800,000 point rally before you can buy. But hey, only that would indicate that the selling has been absorbed. Unfortunately, that seems like a long shot as of now. Friends, in the week before last, this index was number 16 on the most volatile counters list as per statistical beta ranking in-house. It slipped 1 notch to number 15. Again, because individual stock futures volatility rose. Last week, I advocated an estimated range between 23,425 on the upside and 22,175 on the downside. Admittedly, our support level failed and was exceeded by 70 points intraday on Friday because the low was 22,105, whereas I had advocated 22,175. In the coming week, the estimated range is between 22,675 on the upside and 21,575 on the downside. Watch the pivot levels and the pivot videos that I have put up here, the links to which are below. Also, please keep your stop losses diligently and put up tail risk or Hacienda hedges. The video on what Hacienda hedges are is right here. Now, friends, I come to the last bit of statistical analysis wherein I analyze the retail risk appetite by their footprint in the 4 derivative segments in the market. Index futures indicated as a blue line, their turnover contribution went up by 11 basis points. Stock futures turnover went up by a whopping 79 basis points, indicated by a red line. Index options fell by a whopping 0.98%, indicated as a green line, and stock options turnover contribution went up by 9 basis points, indicated as a purple line. Now, what does it tell you? Futures demand more money by way of span margin and mark-to-market margin and are more volatile. Why is the turnover in futures high? Does it mean risk appetite has gone up? Partially, yes. Do remember what I told you in the volume segment. Expiry. Traders are rolling over their trades from February to March, which means selling turnover here, buying turnover here. That results in a spike. So the real price discovery process will start in the week ahead. Now, friends, I come to my trading strategy for the week. I'll keep it short. I'll keep it sweet because there's no change absolutely whatsoever. I'd trade all PSUs as far as possible. In this video, I've explained to you why PSUs enjoy a statistical advantage for intraday traders in both direction, long and short. The intraday price moves tend to be a lot more cleaner and wider, and therefore there's a statistical advantage. Watch that video. I'll focus on interest rate sensitives. I've been writing a lot about that on my Telegram channel. I'll focus on energy, and I'll continue with my game plan of theta decay, which I have been advocating since many months now on these counters, and also on energy commodities. Now, bullion may fall as I have advocated in this video. Why? It was expected, like I've said in this video, because once the market starts to correct in other asset classes, there would be a mark-to-market payment crunch. People will be compelled to sell all other assets to pay their mark-to-market margins to the broker, failing which the broker closes your trade. So currently there is a flight to safety, flight to cash, and even bullion is falling because of profit taking. But is the long-term story still intact? According to me, yes, very intact. Look beyond 2025. As a matter of fact, I rephrase, look far beyond 2025. Keep your delivery positions intact. Industrial metals saw the expected month-long short covering, and which is why the prices went up initially and then succumbed to profit taking at higher levels. What does it tell you? That means metal mining stocks will have limited upsides, and any rallies will be met by resistance and therefore pressure at higher levels. Friends, I told you that I would share something on MWPL when I was discussing our in-house indicators. Now, what I saw was frankly quite concerning. I have been talking about dipping disinformation protocol in some videos some months ago, and on my Telegram channel I told you why I have raised the disinformation or the masking of trades to fool retail investors to Maskirovka levels, which is military level deception by the term used by the East European armies. Now the Maskirovka level has stepped up. Why? Why am I saying that? As a guy who plays by statistical trading models, I saw MWPL in select counters plunge to multi-quarter lows. I'm not saying months, multi-quarter lows. Unfortunately, due to SEBI stipulations, I am not allowed to share any charts with you which are any more recent than 90 days ago. So what I saw on Wednesday, remember Wednesday, not expiry yet, Wednesday onwards, I saw MWPL on certain counters fall like a crashing aircraft. What does it tell you? Big money I saw was bailing out of these counters. And that is where absolute amount of overhead supply will come in. And that is where crowded exits are making the stock vulnerable. If you've started maintaining MWPL files and figures for yourself, you could basically use that in an Excel sheet. I've shared the hyperlink with you as to where you can get it from for free, of course. And if you've done a little bit of homework, you would have already known which counters that I'm talking about. It takes a little bit of homework to do, but hey, whoever told you making money was easy? As a matter of fact, the old saying goes that a trading profit is the most difficult, easy money you will ever make in the markets. Friends, if I have any more ideas to share with you, I'll gladly do so on my social media accounts, starting with Telegram and WhatsApp channel. Do connect with me there, please. Before I wind up this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put about here. In the comment segment, do let me know how my videos are helping you and how I can make videos on topics that would help you become an even better trader. And a request, please share our videos with all your friends, your family, and your social media groups so as to help us to reach out to a wider audience. It is a love's labor that makes us record and upload and edit these videos and put up there. It's a time consuming process. So if it can reach out to a wider audience, I'd be very thankful. Friends, thank you for your patience in being with me in this video till we meet again in my next. This is Vijay Bhambwani signing off for now. I wish you have a very profitable week ahead. Take care. Bye-bye.